Welcome to the Smart Money, Dumb Money Show. I'm your host, as usual, Keith Richards. I am President and Chief Portfolio Manager of ValueTrend Wealth Management. And today we are going to talk about the Loonie. Now, the Loonie matters. And the reason the Loonie matters is for two reasons. First of all, here in Canada, we buy a lot of US stocks. And whether you choose to keep those stocks in a US account or you keep them in a Canadian account, one way or the other, you're probably going to be converting those dollars, those US dollars, into Canadian dollars at some point. The other type of people that are affected by the movement of the loonie versus the US dollar are snowbirds, because snowbirds, like myself, I'm not a full-on snowbird. I have a place in Florida, but I come back and forth, and I do spend some time in Florida. So when I'm in Florida, I'm spending US dollars. So it's important for me to try to take advantage of rallies in the Canadian dollar and buy US dollars, so I'm not spending so much when I'm down in the States. And this goes for anybody that does any extensive amount of traveling in the States or snowbirding or anything like that. So it's investors that can be affected, it's travelers that can be affected. So we should take a look at the loonie and see what's the outlook. So I'm going to share with you a bit of a presentation I did. I call it Snowbirds Beware. It's not really just for snowbirds, but what my belief is that the recent rally in the loonie may be a head fake, and this is recorded on October 8th. So in fact, some of the factors that I'm going to discuss today showed up this morning when I came into the office, and we saw some movement on the Chinese markets overnight because they're telling us that, oh, you know, that stimulus we planned, it's probably going to be a one and done. So we'll talk about that later. So we're going to look at US seasonality, and pardon my spelling, I put seasonally. So I guess I spelt things wrong, but that's because I was in a hurry to get this out to you, because it is, I think, important based on what I saw on the market this morning. So we're going to look at seasonality. We're going to look at the US technical trend, the US dollar technical trend. We're going to look at the Canadian dollar technical trend. We're going to look at the relationship of the Canadian dollar to oil. We're going to look at the relationship of equities to oil. And then we're going to take in some economic considerations, like what's happening in the world today, and then we're going to come up with a conclusion. So let's get started on all that. There's a few charts we have to look at. The US dollar seasonals, see, I spelled it right this time. This chart is courtesy of Equity Clock, and what you can see is that I am talking to you on October 8th. This will probably be seen next week, but whatever the case, the month of October usually represents typically a lower point on the US dollar. That kind of works out because the Canadian dollar had a couple pennies upside recently, and it typically reverses, and you see lots and lots of strength on the US dollar, literally up by 1% or so over the coming month. Okay, so keep that in mind. Now, typically it eases off after that, but the real muscle on the US dollar, as you can see on this chart, is from January until April. All right, so that's a good period of time. That's a good 3+ months where you can see the US dollar rise by, remember, this is the zero line down here. It's a percentage, and this is 2, this is 2.5 actually. So you will see something like 2 to 3% on average rally on the US dollar over the winter. That's a lot. Okay, we should keep that in mind, because that's a movement up on the US dollar means not so good for the Canadian dollar. Okay, so let's take a look now at the technicals. This has nothing to do with seasonals. This is just what's happening with price. Well, this is the US dollar against a basket of world currencies. This is not something you can actually go out and spend, although you can trade it with different instruments. So it tells us what the US dollar is doing in general, not just against the loonie, but you can see there's a really well-defined trading range, $100 support, about 106, 107 resistance, and it, without question, bounced off of that recently. Okay, it bounced off of that $100. Like, isn't technical analysis wonderful? It's not just lines in the sand. This stuff works. It's because it's real people, real traders watching these trends, and these things happen because of supply-demand economics. So now the US dollar is in demand, and you've got some seasonality, at least in the short term, because over November, October, November, you tend to see some movement up in the US dollar. Well, surprise, surprise, what's happening? Will it get to the 106, 107? I don't know, in the next month, but maybe it will over the winter. So keep that in mind. If you're buying US dollars, might be a good time to buy soon, if all of this stuff is right. And all of this stuff is just analysis. It doesn't mean it's actually going to happen, but it's probability. And probabilities, as you can see, as I build my case, are greater as we see evidence for the US dollar to see some strength. And that doesn't necessarily mean the Canadian dollar will fall, but it often does. So let's look at the Canadian dollar. And this is a chart that I've been drawing literally since about 2000, somewhere around there. And the chart, I used to draw it on chart books before I had internet connections to all this wonderful software. But the trend has been since around 2015 that the Canadian dollar has been trapped. Now, the original lid was around 83, as I've marked on the chart, and then it moved to around 78. But really, the main support levels and resistance levels I'm paying attention to right now is support at 72. Now, you can see there's been two instances, 2016 and 2020, when it bottomed. Both times oil fell a lot. Okay, and of course 2020 was COVID, and people tend to fly into the US dollar just to be safe. All right, but in 16 there was a sell-off in oil, and so too was there in 2020. You might remember that reversal on the barrel of oil. It actually went negative for a very, very brief period of time. I think it was only 1 day or something, but it was because of storage concerns. Okay, so let's say that on average support is 72 cents, and on average lately, anyways, it's been about 76. It just bounced off of 72. Isn't technical analysis wonderful? Seems to work like magic. So you can see 72 was support. You might remember I did a couple of videos recently, and I said, hey, if the Loonie cracks 72, we're in trouble. We'll see 68 cents again. But it didn't, it held support, and so it bounced off. Now it's around 73.5 as I speak on October 8th. Well, that could move up to 76 or not. So far, some of the evidence based on the look of the US dollar and based on the look of the seasonal chart suggests that's a 50-50. It's a flip of a coin. All right. So all we do know is it's moved up a couple of pennies or a penny or so since the 72 bottom. Okay, so let's take a look at the relationship between the Loonie, which is in red, and the barrel of oil, WTIC, West Texas Intermediate Oil, and what that relationship is. So before we look at the chart, I really actually want to focus on this lower pane. And this lower pane is what's called a correlation pane. And what it tells us is whether the Loonie is acting in correlation, in lockstep, in similar movements on a percentage basis to the barrel of oil. And you can see most of the time there is a correlation in movement, meaning they move together in some form. Oil tends to lead the Loonie. Okay, now just how to read this chart, by the way, the horizontal line is 0, meaning there's no relationship, and the line below the horizontal line means negative relationship. They're moving opposite to each other. You can see most of the time the relationship is positive. You can see lately that relationship has reversed. If we go back in time, and I haven't drawn a big enough chart because it would squish the data too much, but if we go back in time, we would find that whenever this relationship goes negative, as it has now, it tends to revert. You know, you've ever heard the expression reversion to the mean? It tends to revert back to being a tight relationship later. So it's a short-lived phenomena, but we're in that phenomena right now. So the Loonie is not following the barrel of oil, because if you look at the barrel of oil, it's been kind of flat. Okay, so let's look at the relationship between a barrel of oil, the black line, and the TSX, the stock index. And you can see it just in the same way as when we were looking at the Loonie. There's a very strong relationship. One goes up, the other goes up, one goes down, the other goes down, etc. Okay. We look at the bottom pane here, most of the time, even more so than here, where it was a little bit more erratic, most of the time the TSX itself is driven by the price of oil. Why is that? Well, 30% of the index is in materials. That's oil, gas, and of course, materials like forestry products and metals, which are a biggie. okay? So materials are really, really important to Canada. Oil is really, really important because a lot of our GDP comes from oil. Can somebody please phone Prime Minister Trudeau and tell him that? Because he doesn't seem to understand that. So now that we see that there's been a strong relationship between the two, and most of the time it's positive, once again, we have a little bit of negative relationship between the two. So that's probably going to change. We're going to need oil to move up for the TSX to move up. It has recently moved up a bit, but it's mostly been the other side of it, the materials, such as copper and whatnot, because of the China stimulation plans. That's driven the TSX quite strongly up in the past couple of weeks. All right. So what I'm just pointing out is that eventually, though, oil is going to have to support both the Loonie and the TSX itself, the TSX equities. Okay. So that's the look of oil. And that's against both the Loonie and the index. That's the look of the US dollar chart. That's the look of the Canadian dollar chart. From a technical perspective, we saw the seasonals on the US dollar, so the reciprocal is true on the Canadian seasonals. So what we need to do now is take a look at some economics. And this is David Rosenberg's comments right out of a report I read just today, actually. And that is that he said that the Canadian dollar has been held together by, as I just mentioned, because everybody knows this, the Chinese stimulus, which of course helps the commodity market. He says that eventually the Chinese stimulus effect will fade. In other words, everybody gets over the excitement, and so will the war on the Middle East, which is helping oil a bit lately. Okay, it's fairly new because of the movement into Iran by Israel. All right, the prospect of the Bank of Canada cuts being higher than the Fed are very high, and I'll tell you why. Because the Canadian economy versus the US is drastically worse. In fact, the Canadian economy, sorry again to break the bubble that Krista Freeland seems to be telling us in Parliament, she's telling absolute untruths, where she says the Canadian economy is in good shape. It's not. It is not in good shape. We are the dead last in GDP growth in the developed world. Dead last, not second last, not middle of the pack, but dead last. We are dead last in productivity, dead last. So with these in mind, the Bank of Canada knows that it has to stimulate, and so it's going to continue lowering rates, but it already did begin lowering rates well below, before I should say, the US started, and it's going to be equally, if not more aggressive, with continuing to cut rates, because they got to get us out of this economic doldrums before this turns into an outright serious recession. All right. So what does that mean to us when we look at the Loonie? Well, if you've got foreign investors looking to buy bonds, and that's how currencies are influenced by foreign investors, they're going to look at rates. And if you're getting a very, very low rate on the Canadian bonds, then you're going to be less enticed than buying a country's bonds that still has higher rates, such as maybe the US or other countries. So the lower the rates, the worse it is for the Loonie. All right, so we have that as another reality beyond all the other factors I just showed you. So David's conclusion is it's difficult to be bullish on the Canadian dollar at current levels. And I tend to agree with him based on all the evidence we just looked at. So in conclusion, I'll just rip through this because you've pretty well got the message, I think, by now. I think the Canadian dollar's recent rally by a penny and a half to 2 pennies, whatever it's been, may be a head fake. I do note that seasonality is temporarily good to November for the US dollar, but the real meat is from January to March, and that's going to be bad for Canadian dollars, all things being equal. Okay, but things aren't equal, because you've got technicals working for the US dollar as well. The US dollar is bouncing off of a major support level, and the Canadian dollar looks kind of like it's stalled, hasn't it? It has a range of 72 to 76. It only moved up a penny and a half, and now it seems to be, if we go back to that chart, looking a little bit wavering, let's say. So it may be stuck at 73.5 cents, or maybe even fall back down again. And that's my thoughts sometime over the winter, not necessarily next week. Canadian dollar may have trouble bouncing off support if the US dollar moves to the top of its range. Okay, that's simple math. And historically, oil and the dollar, as well as the TSX 300, are correlated. Not lately, but I think that'll return. And if we don't have a strong oil market, then we won't have a strong loonie. Now, I do actually think we're going to have a strong oil market, but I don't think that it's right now. I think that this blip by the Chinese and the blip by the news coming out of Israel moving against Iran, I think that's a news item, but I don't know if it's a trend yet. So keeping all that in mind, I think trend wise, we'll see a move up in oil, but that may take a number of months. So in the meantime, the loonie is vulnerable. So final thing is that I don't think I personally would bet against the US dollar and be buying loonies against the dollar. In other words, if I was buying an ETF or something like that and it had a option to hedge against the US dollar movement down against that loonie, I'd say probably not worth the extra cost, at least for the next few months. All right, thanks for watching, and we'll see you next week.